Big ideas require big capital. And behind every empire you admire out there is someone who's mastered the art of raising it. Elon Musk, he's raised over $75 billion. Warren Buffett, he's built his empire by attracting capital from others. And every real estate tycoon you know of, their portfolio didn't grow from their savings. They scaled by raising capital. So if you're building something that matters, your ability to raise capital is not optional. It's literally the difference between slow growth and true scale. But here's the problem. Most people don't actually understand what raising capital actually costs. And when they try to outsource it or skip steps or chase shortcuts, they end up stuck or worse off than they started. So in this video, I'm going to walk you through the real cost of raising capital, not just in money, but in time, control, and complexity. And I'll show you exactly what your business needs to look like at each stage if you actually want to do it right. Obviously, I'm not an attorney. I don't even play one on YouTube. So first and foremost, get your own legal advice. Talk to qualified attorneys, accountants, people in the compliance space, because raising capital is a regulated activity and you need to do it the right way. Now, this video is for context and it's an educational video, so please make sure you use your judgment and protect yourself when you're actually out there in the marketplace. With that said, there are 7 stages of raising capital. Now, each one has trade-offs, but each one also unlocks more money, but it's also going to require more from you. So I'm going to show you exactly how they work and what you're really trading at each level. More importantly, I'll show you why most people get stuck and what happens when you try to operate at one level while your business is still at another. So let's dive in. So for each stage, we're going to walk through what it is, who it's suited for, what your business might actually have in place to qualify, the pros, the cons, the limitations, both in terms of time, money, and the control trade-offs. So let's get into it. The first stage is a joint venture. So this is where you and your business partner contribute capital, time, and expertise. There's really no outside influences. There's no one else putting in any money. It's just you and your partner, maybe doing a single acquisition of a building or a business or something like this. And the requirements are fairly low because you're just getting started. Maybe there's no formal team or structure yet. Your legal costs are going to be a couple $1,000, maybe 1 to 5 grand. The time commitment to getting this set up is relatively low because things are pretty simple. You typically have a high degree of control of what's going on. And the reason why this deal makes sense for you at this stage is because you know each other, your partners, your friends, you guys have done stuff together, and you can access some capital, maybe up to $250,000 with this model. It's a simple structure. Typically, people make fast decisions, and you have really good alignment here. Now, the limitations of a joint venture is you typically have very limited capital access, you have little leverage, and you also have a model that's not really scalable. The next tier is family and friends syndication. So this is where you're typically going to collect some small checks from your personal network. Ideally, the family and friends syndication model works really well for a single acquisition, a single business, a single real estate property, whatever it is. It's typically one very specific acquisition based on your warm network of people that already know, like, and trust you. I call this trust-based capital. The good news here is that the amount of money you're going to spend to do this deal is relatively low. Your legal might be $5,000 to maybe $15,000. Your time cost to get this set up will be fairly low, maybe a little bit more medium if you haven't done much business in your life. You do retain a high degree of control because ultimately everyone in that deal will be trusting you. You can keep the deal as simple as possible. And ultimately, that trust-based model, in terms of being able to access capital, is, depending on your network, could get you $250,000 up to maybe $1 million. Now, the pro to doing a family and friends syndication is it's a relatively quick path to capital with minimal sophistication. The limitations to a family and friends structure is that the investor pool does cap out really quickly and you really don't have any leverage. So in other words, what's working for you with the friends and family approach in terms of how you position and describe the deal and the opportunity won't work for you in the next tier. So what I mean by leverage is everything you've done well with reaching out to your friends and family and your warm network, those things aren't going to work at scale because nobody knows you at scale. which is why we have the next level. The next tier is the formal retail syndication model. So this is where you start to bring in outside external investors using pitch decks, a CRM, webinars, conferences. This is when you work to get your name out there. These types of models work really well for single acquisition. So in other words, you're buying a business, you're buying specific property, and the reason why it works really well for a single acquisition is because you have proof of concept, you've got a clean structure, and hopefully you've already gone through the friends and family thing and done some deals well to be able to show a little bit of a track record. Now, doing a retail syndication offering is more expensive. There's more legal documents, more compliance. There's probably going to be more back and forth with your investors and your legal, and expect to spend at least 15 to 25,000 here. But the great news is if you set it up properly, you're going to be able to talk to strangers. You're going to be able to go out into the marketplace and actually solicit capital from people that don't know you, which is going to give you that scale beyond your friends and family. Now, setting up this model is going to take a little bit more time as well because investors that don't know you are going to negotiate terms and controls and things with you. So the time spent to put the documents together will become more cumbersome. You're going to have to potentially give up more control, more voting rights, things like this. And you know what? For the extra couple $1 million that you can access in capital, in my opinion, you'll be able to access at least an additional $1 to $3 million at this stage. For a lot of people, it is definitely worth going through. Now, the pros to setting up a retail syndication model is you actually step into the game for real this time. So you're now actually dealing with real investors outside of Uncle John, who's known you for the last 20 years, and your neighbor who's always been in your corner kind of thing. So learning how to deal with real investors is a pro in of itself, and this tier allows you to do that. The challenge also at this tier is you're still relying on you to make it all work. So you don't have any systems, you don't have any processes. You're just trying to sell your way through it, use your charisma if you have it, and use the goodwill and just get in front of people. You're more pushing at this point rather than pulling. And over a period of time, that can get exhausting, which is exactly why the next tier is super valuable. The next phase is the scalable in-house systems phase. So this is where you start to implement funnels, a formal CRM process, content nurture sequences. Your business starts to develop what I call a capital engine. And ideally, you're doing this because you've decided that you want to buy multiple assets in a similar space, or maybe you want to set up a fund that buys multiple assets. The point is, you've decided that you're going to be consistently requiring capital to fulfill the needs of your business. Now, the business at this point is going to have a clear offer, consistent deal flow, start building out a little bit of a team, and have the capacity to be able to execute. At this stage, also, it's really important to have what I call your unfair advantage locked in. So you're now attracting people rather than trying to push things onto people, which is super important at this level. You're going to be investing more capital in your business at this point as well. 20 to 50,000 becomes much more of a normal price point at this point. And the good news is when you start to operate at scale, you can actually have the business pay for this stuff rather than you coming out of pocket. Now, that's probably a video I'm going to do for another day, but trust me, when you start to scale, the business starts to carry itself rather than you going into your pocket every month trying to keep everything going. Now, things do get more complicated with your legal documents and your disclosures, and you have to negotiate ownership and structure with investors and things like that. But you know what? For being able to access $2 to $25 million and being able to do that consistently, it's definitely worth it because you start to now build out a controlled investor group, which is scalable. It starts to become brand driven where people are now looking to you in your next deal and really lean into working with you over the long term. Now, like I said, the limitations are is you start to have to build out some infrastructure. It's not plug and play out of the gate, so it does require some work, but it is the difference between people that end up playing really small to people that start scaling is the ability to incorporate that next phase. Tier 5 is the partnership model. So this is where you start to potentially co-GP, bring on consultants, maybe have investor relation firms assist with the raise, Profit sharing is often required at this point, and again, you need to work with your lawyer to make sure you're compliant and doing things correctly. Now, people typically use this model for a single purpose acquisition, or I've seen people do this model for the purposes of creating a fund. Now, from your perspective at this point, you definitely have to have experience, some results, and you have to have value to be able to contribute to a partnership. Expect to spend $50 to $100,000 at this point, plus share a portion of the profits. Again, if the deal is big enough and things make sense, paying $50 to $100,000 to potentially make a couple million is a good investment. Now, I'll make a separate video at some point on how to split deals and how to do that. But for the purposes of this, expect to spend some money. And hopefully, if you're structured right, the business is paying for that. Your control in that business is dependent on how you structure it, but you do have to start to share some control with the other partners. The complexity, depending on your understanding of how to do things, could be really simple or it could get really complicated. But the good news is if you nail this phase right, you could raise an additional $2 to $25 million a year within this model. Now, the pros here is obviously you have shared responsibility, so there's more people carrying the load. You have a bigger network to tap into. But the limitations are, well, you have to obviously share the upside. You have to make sure that you and your partners are aligned and that you guys are on the same page in terms of where the business is going to go long term. The next tier is the broker dealer model. So, this is where you find licensed third parties to raise capital for you. You pay them commissions, you pay them fees, you give up a share of the GP. And ultimately, this is ideally suited for if you have a very specific large deal you want to do or a fund that has a very specific investment thesis tied to it. Now, to be able to operate at this level, you have to have a buttoned up business plan, full team, full legal structure, data room track record, the full 9 yards. Also, you need to have a big budget because you're going to be spending $100 to $250,000 here. Plus, you're probably going to be paying 5 to 10% commissions in terms of how much money you need to raise. So if you're raising $20 million and you're paying a 5% commission, that's a $1 million commission check that you have to write to the broker dealer. That's obviously how they get paid. Now, part two within the broker dealer world is they typically want options or warrants, which is the fancy way of saying is they want a piece of your GP, your general partner. So if you do a 70-30 split with your investors, that 30% of your pie, they're probably going to want 10 to 30% of that piece as well, in addition to the fees up front. So broker dealer models are a very fast way to grow your business if you're already a big business. Now, if you're still building and scaling and you're not running an 8 or 9 figure business, you're going to have a very hard time getting a broker dealer to care because, from their perspective, they'd rather take somebody who already has a big business that they can go in position with their investors. It's really hard for a broker dealer to say, hey, there's a really good guy. He's done this once or twice. He wants to do this at a 10x level versus, hey, here's somebody who's already done $100 million worth of these deals and they want to do another 20. That's an easier sale. So again, broker dealer, I've accessed that channel over the years. It's fantastic. We've launched multiple funds there. The challenge is if you're not prepared to spend 6 figures up front, and if you're not prepared to do the work on an ongoing basis to maintain that relationship with a broker dealer, and you're not running a big business already, the broker dealer model is something that maybe you revisit down the line. So, broker dealers, the pros are big capital access. There's a white glove network that you can tap into, but there's also limitations. Number one, you've got massive costs. Number two, no one talks about it, but there's no guarantee of a raise. So, in other words, you have high overhead and you have no guarantee of an outcome. On the paperwork that you sign with a broker dealer, and I've seen this multiple times, it says best efforts basis. And there's nothing wrong with that as long as you understand that going in. And the last tier is called institutional capital. So this is a private equity firm, a family office, an institutional fund wires you a large check. Now, at this level, they own part of your company. So this is ideally suited for, again, a very specific single purpose acquisition of a building or business or a very specific fund that they've bought into your thesis for. Now, to have an institutional investment, trust me, you need to have an institutional grade business, which includes audited financials, full corporate governance, independent board of directors, significant legal disaster recovery plans. there are a lot of things you need to have in place within your business that are checks and balances before someone comes along and writes you a multiple 8 or 9 figure check. So financially, be prepared to spend $50 to $100,000 upfront just to work through the compliance of being able to work with an institutional investor and expect major dilution on the back end. So in the context of, let's just say you're buying an apartment building, and on the retail syndication side, you're offering, let's just say, a 70-30 or 60-40 split. With an institutional investor, your minimum 80-20, 90-10. And that's just on one side of the spectrum. So again, there's a lot of value in getting a really big check as a partner, as an investor, but there's a lot of things that you're going to be giving up. So again, you get access potentially to major funding. There's brand credibility because if you have one of the major banks or institutions invest in you, that gives you, the credibility of having them as a partner. Limitations, like I said, you're going to be giving up board seats, you're going to be giving up the direction, the profit share, and ultimately the long-term flexibility in building your business. So here's what most people get wrong. They try to operate at a tier 4 or a tier 5 business while they're actually stuck at tier 1 or tier 2. So look, I get it. You want the vacation, you don't want the trip, you don't want to go through the TSA line. I understand that. The challenge you're going to have, though, is you haven't built the systems, the story, or the structure that investors trust. And because of that, you're going to have a hard time going beyond tier 2 or 3 without those things. Look, capital doesn't go to the person with the best idea. It goes to the person whose business is actually ready for it. And look, this video wasn't meant to tell you what stage you should be in. It was meant to show you the truth about where you actually are. If the things that I've brought up, you're like, well, I can't do that, I'm not ready for that, it gives you an idea of where you're at and where you maybe want to aspire to. And once you know that, you can actually make the right moves to get to the next stage. Now, remember, you don't get to skip steps. I've been at this for 20 years. No one skips steps. You don't get to tier 5 without tier 1 infrastructure, but you also don't have to be stuck at stage 1. So pick your stage, own it, build what your business needs at that stage to be able to attract the level of capital that you need where you're at today, not where you think you want to be tomorrow. And look, if you do all of that, capital will follow. So the question is, what stage are you in, and what's the next thing that you need to do to grow your business? So guys, if you like this content and you want to learn more about capital raising, deal structuring, and understanding how to scale and grow your business, make sure you hit the subscribe button and follow me for more content.